A shaky foundation, weak corporate earnings and investor confidence. The Indian stock market is currently experiencing a period of significant decline. Benchmark indices like the BSE Sensex and Nifty 50 are reflecting this downward trend. The Sensex is down, hovering around 75,967.39. The Nifty is also showing weakness, resting at approximately 22,945.30. This downturn is fueled by a confluence of factors, creating a sense of unease among investors. One of the most significant contributors to this decline is the wave of weak corporate earnings reported recently. Companies across various sectors are failing to meet market expectations, casting a shadow over the profitability and growth potential of Indian businesses. This lackluster performance is shaking investor confidence, leading many to pull back from the market. Disappointing quarterly results from prominent players like Zen Technologies and Patel Engineering have amplified these concerns. These companies, once considered bellwethers of their respective industries, are now grappling with challenges that are impacting their bottom line. The auto sector, a key driver of the Indian economy, is also facing headwinds. Uncertain demand outlooks and supply chain disruptions are weighing heavily on the industry, further contributing to the overall sense of pessimism. Global headwinds and domestic uncertainties, navigating a turbulent economic landscape. The Indian stock market does not exist in isolation. It is undeniably influenced by global economic forces, and the current global landscape is far from stable. Geopolitical tensions, particularly the ongoing trade war between major economies, are casting a long shadow over global trade. These trade tensions create uncertainty for businesses, making them hesitant to invest and expand. This hesitation translates into slower economic growth, which inevitably impacts corporate earnings and investor sentiment. The Indian economy, despite its relative resilience, is not immune to these global headwinds. Adding to the complexity are domestic economic challenges. India is grappling with a widening trade deficit fueled by rising imports and a depreciating rupee. The surging prices of commodities, particularly oil, are putting further pressure on the economy. These factors combine to create a climate of uncertainty and risk aversion, making investors wary of committing their capital. In such an environment, the allure of the stock market diminishes as investors seek safer havens for their investments. The exodus of foreign investment, FIDs, selling pressures, and their ripple effects. Foreign institutional investors, once bullish on India's growth story, are now heading for the exits. Their significant selling in the Indian stock market is adding further downward pressure on stock prices. This exodus of foreign capital is driven by a combination of global and domestic factors. Rising interest rates in developed markets, particularly the United States, are making investments in those economies more attractive. FIIs, seeking higher returns, are pulling out of emerging markets like India and redirecting their funds to these safer havens. The weakening Indian rupee is exacerbating this trend. As the rupee depreciates, the value of FII investments in India, in dollar terms, diminishes. This depreciation makes holding Indian assets less attractive, prompting further selling. The impact of this FII selling spree is significant. It not only directly impacts stock prices, but also weakens the Indian rupee further. This creates a vicious cycle, making it increasingly difficult to attract foreign investment back into the market. Even before the recent downturn, concerns were brewing about the Indian stock market being overvalued, while strong economic fundamentals and positive investor sentiment fueled a bull run in previous years. This optimism led to some stocks trading at prices not entirely justified by their underlying earnings. This disconnect between market valuations and actual corporate performance creates a fragile situation. Any negative news or economic shock can trigger a sharp correction, as investors rush to reevaluate their holdings and adjust their portfolios. The recent wave of weak corporate earnings, coupled with global and domestic uncertainties, has acted as a catalyst for this correction. Investors, once willing to pay a premium for Indian stocks, are now demanding greater justification for high valuations. This shift in sentiment is particularly evident in the small and mid-cap segments of the market, which had witnessed significant rallies in recent years. These segments, often considered riskier but offering higher growth potential, are now experiencing sharper corrections as investors become more risk-averse. The Indian stock market is currently navigating a perfect storm of challenges. Weak corporate earnings, global economic headwinds, FII selling pressures, and high market valuations have created a climate of uncertainty and volatility. Investors, understandably concerned, are reassessing their positions and seeking safer havens. While the situation appears daunting, it is important to remember that market cycles are inevitable. Periods of correction, though painful, are often necessary to adjust valuations, weed out excesses, and lay the foundation for future growth. The Indian economy, despite the current challenges, remains fundamentally strong. Favorable demographics, a growing middle class, and the government's focus on structural reforms offer hope for the long term. Investors, however, need to exercise caution and prudence. Thorough research, diversification, and a long-term investment horizon will be crucial to navigating these turbulent waters and emerging stronger on the other side.